So if there's one topic in financial accounting that tends to confuse a lot of new students, it's definitely this topic of comprehensive income. So you might be thinking, hey, why do we have comprehensive income? We already have this thing called net income, and we make an income statement to calculate net income. What is this comprehensive income? What's so comprehensive about it? How is it different from net income? So let me just start out by defining comprehensive income. And comprehensive income is all changes in equity during a period, during a quarter, a year, except those resulting from investments or distributions by owners. Okay, so obviously if the owner takes money out of his or her business, that's not a loss or anything like that. And that's just, we know that's obvious. So well, what is really different here? Well, we're just saying all, right? Net income is not all changes in equity during the period. That's the main difference. And so you might be thinking, okay, well, what is excluded from net income? Okay, what is not in net income that is in comprehensive income? Well, there's this thing called other comprehensive income, which is basically a list of items that are purposely excluded from net income. And so I'm going to have a separate video on other comprehensive income. We're not going to get into that today, but suffice it to say that there are things that do not go through net income. And so then we have to say, okay, well, now we need a more comprehensive, a fuller version of income that encompasses all the changes in equity during the period. So I just want to talk about how comprehensive income would be reported if you were looking at a firm's financial statements or their 10K. So one option that a firm has is they can just put together two statements, right? So they've already got an income statement, right? So they've got the income statement and you've got your revenue minus expenses, and then that gives you net income. Now you could just say, okay, well, now we're going to have a statement of comprehensive income. So we'll just call it CI. We'll have this CI statement, and we'll just have these two. Right, and comprehensive income statement, we'll just start with net income, right? Just carry that up there, and then now we'll add in other comprehensive income, whatever that is. It could be positive, it could be negative, and then that gives us comprehensive income. So this is pretty simple if you think about it. We're just saying that net income doesn't include certain things. What are those things it doesn't include? Well, it doesn't include other comprehensive income, these kind of side items that bypass the income statement. So we'll just add these things to net income, and that'll give us comprehensive income, and we have a statement for income, and we have a statement for comprehensive income. So that's one way of doing it. Another way is to say, well, let's combine the two statements, right? So with this combined idea, we just say, okay, well, we're going to have a statement of comprehensive income, and then on this statement, net income is basically a subtotal. So we've got revenue, and then we subtract out the expenses, right? And that gives us net income, just like above. But now, instead of creating a separate statement, we're just going to add in other comprehensive income right there, and then that gives us comprehensive income. So it's really kind of a similar thing. Instead of breaking it out into two statements, we just kind of combine it. We just keep adding to net income. Once we have net income, we just add in other comprehensive income, and that gives us our new bottom line of comprehensive income. And the final way that firms can kind of deal with this comprehensive income, because it's mandatory that they have to report it, I should have said it. So the third way that they can deal with it is they can include it in this, include their CI in the statement of stockholders' equity. So the statement of stockholders' equity is basically similar to the statement of retained earnings in that it's basically a big T account. Only in this case, it's a big T account for stockholders' equity. So you'd have something like, say, okay, what's the beginning balance of stockholders' equity, right? And then you'd add in net income, or subtract if it's a loss. Then you add in OCI, other comprehensive income for the period, and then that's going to give you the subtotal of comprehensive income. And then at the bottom, you just have your ending balance now for stockholders' equity. So you have stockholders' equity you start with, you add the net income, and then you just say, okay, wait a minute, there's some things here that don't go through net income. They bypass the income statement. They're called other comprehensive income. We add that in as well. That gives us the comprehensive income, and then now we can say, okay, let's look at the stockholders' equity plus the comprehensive income, or minus it if it's negative, is going to give us, should give us here our ending balance of stockholders' equity. And so then we'll just have, and there are other things that can affect this as well too. So let me just say we have like a total here. In this case, you'd have comprehensive income. You can put this in columns. Some firms will do this. They'll have retained earnings. They have all these different things. And then, of course, if the firm issued dividends, that's another issue to contend with. But basically, you just put together a statement of stockholders' equity, a big T account of what happened. And then comprehensive income is a subtotal within that statement.